Hey guys, my name is Imran. I'm the head of marketing for Kyberswap. Good morning, good evening, good afternoon to all Kyberians, DeFi people, crypto people. It's time for another AMA session. Today we've got a treat for you. And every time you come to a Kyber AMA, you always have a treat, but today is a particularly special treat. Today we have Carvis from Lido Finance. Lido Finance is a liquid staking giant, in fact, the liquid staking giant on Ethereum network. It provides a cutting edge liquid staking mechanism powering both CeFi and DeFi apps in its thriving ecosystem. And Lido gives stakers the ability to spend their stake assets on the networks they support. And this includes Ethereum, Solana, Polygon, Optimism, Polygon, and so on and so forth. I could go on, but let's welcome today's speaker, Carvas. Carvas, please introduce yourself, introduce a bit more about Lido Finance, and let's get right into it.
Yeah, absolutely. Super happy to be here. We have been collaborating with Kyber for a couple months now, so it's always good to come and meet your community. So, yeah, super excited to be here in the AMI today. I'm a contributor at Lido. My main focus is our liquidity. So, basically, dealing with a lot of our dexes, a lot of how we distribute incentives, how we try to optimize that, and then also do BD work, which is formally the team that I'm on. And yeah, you described Lido quite well. We're basically a liquid staking protocol where people can overcome many of the hurdles of liquid staking of staking directly natively on the chains, and we can get into that in a bit as well.
Very cool. So, as a reminder for today, all the audience today, we have $1,000 in KNC to give away. And before the live stream, we've selected five questions. So, five winners with five questions will be shared later on during the live stream. So, for those who are here live, pay attention, ask your questions or prepare your questions. There'll be five winners for five people during the live stream for live questions. Um, and prepare your Telegram username in order for you to win and receive your reward. And then after the live stream, we actually have prepared a special activity for everyone who wants to find out more about the Lido Finance and Kyberswap partnership and how liquid staking works, how you can earn more in DeFi, how you can work on all the chains, including Ethereum mainnet that we are particularly talking about today. So we'll share all these details in due course. So for those who are here, I hope you're excited. Prepare your comments, your questions, ask lots of questions, give lots of comments and love in the chat. Make sure that you're tagging and sharing this out to all those who are on Ethereum mainnet, who are ETH maxis, who are in DeFi, who are looking for new opportunities. It's also important that I point out that everything we discuss here is talking about DeFi and the industry. However, we love to disclaim that none of this is actually investment or financial advice. So it's really important that you guys understand that we're speaking as contributors to the industry and not behalf of the DAOs. Please DYOR, do your own research before making any finance decision at all. For those kind of conversations with the community, of course, you should head down to the Lido Finance community as well as the Kyber Network community. So let's go straight to the Q&A right now. So we've got a few questions for you, Carvas. So can you give, to start off with some fundamental information, right? What is a simple example of a farm's design for someone new to DeFi when they're coming into DeFi and trying to figure out and understand farming? Could you give a nutshell overview of this?
Yeah. Um, so farming, it's basically like the word that people use for plenty of different strategies in DeFi in general. But it's basically people seeking incentives or rewards on top of whatever they would receive by doing the strategy itself. So in DeFi Summer 2020, basically liquidity mining was pioneered mostly by Compound, where the idea is that you basically will give out governance tokens. It can be anything else, but normally it's governance tokens to incentivize people to do activities with their funds in DeFi and their tokens that you want to incentivize as a protocol, right? So um, farming ends up being a way to incentivize different things, like I mentioned. So the most common one is just liquidity pools. So AMM pools where people maybe wouldn't be as comfortable providing liquidity there if they weren't being extra incentivized for that, just because, for example, the pool is still small or they're still not comfortable using it, etc. And so normally protocols end up doing a liquidity mining program where they're distributing and giving out some of their own governance tokens or other tokens to those LPs, basically to incentivize them to add liquidity to whichever token the protocol would like to have liquidity for. But there are plenty of other use cases. For example, the major lending protocols, Aave, Compound, Euler, even Morpho now, they all at some point or even currently have like it's also called liquidity mining, I guess, but it's not for liquidity pools. It's more for people supplying and borrowing assets there, where they're also getting incentivized with governance tokens for incentives to make them do those activities. For us, it's mostly liquidity pools, just because ST assets, like we call them, which are basically the token representations of the staked position. So, for example, STETH being the token representation that you can use, you can sell, you can buy, etc. You can collateralize instead of having the native stake ETH. And then we need secondary liquidity for that, which is why we do what you're calling farms, where we basically incentivize people to LP that in Kyber or in other dexes and give them LDO for that service, essentially.
Very cool. So, in the protocol, people stake their ETH, they get their stake ETH, and then there's a version of it, the wrap stake ETH, which then is used for the purpose of dApps, for example, in a liquidity pool, right? So, when discussing this, right, like you have a holder possibly holding ETH, a holder maybe of stake ETH, maybe of wrap stake ETH. Why would I, as a LP, participate in a wrap stake ETH pool with another token, so like a two token pool compared to a pool with let's say just ETH, right? So so that's one. As a follow up question is why would other protocols, other tokens choose to pair up their liquidity then with wrap stake ETH rather than ETH or USDC, for example? So quite a bit complex, but I hope we can go into this.
Yeah, absolutely. Uh, this is actually very important and something that we really do want to communicate externally. So thanks for the opportunity. So most of our pools actually one thing that you mentioned, so stETH can also be used in DeFi, just as wrapped stake ETH can be. So the wrapped version, it's pretty much the same. The simple difference is that for stETH, the yield that you get from the staking itself, so ETH denominated yield, you're getting it by rebasing, which is basically the mechanism by which stETH keeps accruing in terms of balance on your wallet. So every day you'll get a little bit more balance of all of the ETH that you're holding, representing the yield that you're accumulating. And then Wrapstack ETH does not rebase, so the balance that's in your wallet just remains constant, but the value of it starts diverging upwards because it is accumulating that yield inside the token, right? So, but they can both be used. They're both transferable, and they can also both be used in different protocols. It's just a choice in terms of each protocol. Do they want to have their smart contracts deal with that rebasing mechanism for STETH, or do they prefer to just have it as a non-rebasing token, which is normally simpler to integrate for wrapped stake ETH? So, for example, on Aave you would use STETH, on Maker you would use wrapped stake ETH. So, but it's basically the same thing, and the risk profile it's the same between the two. Um, in terms of your second question, so why would people use wraps like ETH in pools against other tokens instead of just against ETH, right? So the fact is that most of our liquidity is against ETH. So it's basically STETH against ETH on Curve or wraps like ETH against ETH on Balancer, etc. And that's, I would say, the primary venue for liquidity for STETH now. And those are very large pools. So they're some of the largest pools in DeFi, and combined, they're upwards of $1 billion of TVL now. Now we're trying to diversify the liquidity as a DAO to have other pairs, like you were mentioning. And basically, the trade-off is that if you're LPing wraps like ETH against ETH, basically you would expect that the trading volume would be somewhat low
Right.
because basically there's not as much arbitrage going on, which is a big driver of volume in DeFi in general. Also, people are not as actively trading in and out of wrapped ETH to ETH positions and back as they would be with, for example, stablecoins. So people that would be speculating on ETH price would not be using this initial pool, etc. And so you'd get a slightly lower volume per the TVL that's there. But on the other hand, you wouldn't have too much impermanent loss or almost none because the price of those two tokens is very, very highly correlated, right? It's pretty much close to one, and over time it should remain close to that. Actually, for the case of Rhapsody, it should diverge a bit upwards, but it's still like very little impermanent loss there. The trade-off between that and then pairing against stablecoins in pools. For example, the pool that we have with Kyber, we have on mainnet, we have one that wraps like ETH to ETH, and that basically functions like the first one that I mentioned. And then we have wraps like ETH to USDC, so stablecoin. And that one, of course, does suffer from impermanent loss. And it's pretty comparable to the impermanent loss that ETH and USDC would suffer on other dexes or even on Kyber. The trade-off is that you basically are getting much more fees, and you're also getting more incentives uh, for LPing there. Uh, Basically, people will want to have actually trading activity between Wrapstake ETH and USDC because they're basically either speculating on the price of ETH or entering ETH positions, exiting ETH positions, etc. And they will do that much more frequently than between ETH and Wrapstake ETH. But you will, of course, take impermanent loss, and basically you will take it if there's very, very high relative volatility between the two tokens, right? So if Wrapstake ETH goes up in price very fast or by a lot in a short period of time, you'll take a lot of impermanent loss, and if it doesn't, you'll basically don't and just collect fees for that. Also, an important point is that impermanent loss, if you don't rebalance the positions, is path independent. So basically, if it goes up in value ETH or Wrapstake ETH in this case and then comes back to the same value that you were LP that, if you didn't rebalance the position, you didn't take impermanent loss and you still collected fees. But yeah, that's basically the trade-off. Basically, you get more utilization in the pool and more volume and more trading fees, and essentially more incentives as well on top of that. Or you're getting much less impermanent loss, but you're also getting much less volume and fees on ETH to Wrapstake these pools. And then the last question, I think I remember all of them. The last question you mentioned. So why would any other token choose to pair their liquidity against Wrapstake ETH? This is actually something that we think about a lot, and I personally think about a lot. And I think it makes total sense. Of course, I'm biased here as a contributor to Lido, but let's imagine that we are a new protocol. We are protocol ABC, and we're launching our governance token in a week from now, right? Which is going to be called ABC as well. Uh, we want some liquidity on chain, and we want to incentivize that liquidity on a DEX. Let's say it's Kyber. And we're thinking about, with our research team or whatever analytics team, we're thinking about, do we want to incentivize ABC token against ETH, against stablecoins, or against any other token, right? The normal choices are to do it against stablecoins or against ETH. A lot of people end up going against ETH because it's just like the canonical asset in Ethereum or in DeFi in general. Our view is that we could do that with Wrapstake ETH instead, because basically if you're incentivizing with new emissions, so if you're paying the LPs additional ABC to LP ABC to ETH, you're basically having to compensate them for some amount, the risk premium that they're willing to take. But if they were LPing Wrapstake ETH on the other side, on the side of ETH instead of ETH, then they would already be receiving half of their LP position with yield from the staking rewards themselves from Ethereum denominated yield. So basically, you have the trade-off where if you pair it against ETH, then you have to essentially reward them a bit more because they're not receiving the native yield from the part of the LP position that would be staked, right? So our view is that if you are a new project and you want to incentivize some liquidity pool, a good choice to consider would be to pair your token, ABC token, with Wrapstake ETH, because that way your LPs are already receiving some yield, which should cut slightly on the amount of incentives that you have to give them on top of that for it to make sense to them. Of course, like the trade-off and the drawback here is that ETH is just the canonical asset, and ETH doesn't really have application layer smart contract risk on top because it's the native asset of Ethereum, while wrapped ETH or any other token outside of ETH will have an additional layer of risk. But it's very battle tested. Lido has been around for a long time, and the TVL is very large. So if you're thinking about that, if you want to think about spending a little bit less of incentives to get the same amount of TVL or depth, I think pairing against wrapped ETH could be a good choice to go. And we're also happy to talk about that. So if you want to explore that, feel free to reach out to me or on our Discord, and we can guide you through it.
Super comprehensive answer. Thanks, Carvas. Before I move on to the next question, just want to say hi to the people typing in the comments. I see it blowing up. Just want to say thanks to everyone saying hi. AppTech says Lido Finance and Kyber Network, the best combo. I think so too. Gilo says, let's go, Kyber and Lido team. Adenike, Altaf, all's good saying, let's fucking go, guys. Fossa says, amazing partnership, guys. Congrats, thanks. And Uncom Fact says that Carvas looks like Superman's guy. I think he means Clark Kent. I agree as well. So very cool. So I see a lot of interesting questions coming in as well. So keep those questions coming and the shares going. And we'll move on to the next question. What are the barriers to entry to stake ETH farming and liquidity pools? And what would you share as strategies for getting through those barriers?
Yeah. So like in terms of, I would say we have different layers of different strategies that you can do that are increasingly added on top of the previous one. So going through the progression, basically you can be holding ETH. So that's the simplest thing. You can just be holding ETH on your wallet. If you want to get Ethereum staking yields, or you also want to help secure the network by increasing the price of attacks on the proof of stake consensus mechanism, you can stake it. In our view, the best way to stake ETH is with the liquid staking derivative. We can also go into that. I'm not sure, Imran, if you want to, but basically you get three main advantages of using an LSD, a liquid staking protocol. Not just Lido, like any liquid staking protocol. Lido is just the one that has the deepest liquidity, which is
Yep.
one of the advantages. So basically, the advantages are, if you wanted to stake ETH natively, you'd have to do it in multiples of 32 ETH. So if you had less than 32, you couldn't. And if you had, for example, 51, there would be some amount of that ETH that couldn't get staked because it would have to be a multiple of 32 per validator, right? So with us, you can stake any amount that you want. So any amount of ETH that you want, you can stake it, all of it, and there's no limits. So that's one advantage. The second one is that if you were to stake directly, basically you would lose access to that to those tokens, to the ether that you staked, until withdrawals are enabled in Ethereum in the next hard fork. So with us, you can basically stake, and then you get a token representation, which is wstETH, what we have been talking about, and then you can just basically exit that position at any point in the future that you want. And we do that by having secondary venues for liquidity, which are basically the dexes, like we have on Kyber. So you could go to Kyber and basically sell out of your wstETH position and get ETH back at a pretty good rate. So that's the second advantage. So you don't lose access and you don't lose optionality on exiting those positions at any point in the future, as you would if you were staking directly. And then the third advantage is what we're going to cover here in this question, is that by having the token representation, by having wstETH as a token on your wallet that's representing your Ethereum stake, Ether staked position, you can basically use that as a composable Lego in different DeFi strategies, right? So you can basically LP that, you can use that as collateral in Aave, Maker, and others, or you can basically switch between these different strategies as you want. And you couldn't do that if you were just staking ETH directly. Or if you were staking in, for example, in an exchange that wouldn't give you a liquid staking derivative. So those are basically the three main advantages, and that's why we think that liquid staking is actually the killer app in terms of staking itself across different chains. So that's kind of the context. And now going into the question itself. So the simplest thing you can do is just go to the Lido website or to a DEX and just get some stETH. So the two ways of doing that is basically, for example, you can go to Kyber or to another DEX, and you can purchase stETH from other people. In this case, from pools. And if you do that, you basically get the market rate for it. Alternatively to that, you could choose to just stake directly by going to the Lido website and just depositing new ETH and staking that. So those are basically the two ways of getting into an stETH position or wrapped stake ETH position. And then once you have that, basically a whole host of DeFi opportunities open up to you. So one of them would be LPing, which is basically the main reason we're here and the main reason we partnered with Kyber. So you could go to Kyber on mainnet or on L2s, um, and yeah, in this case for Rhapsody on mainnet and L2s, and basically LP there against another pair. So you could do that between Rhapsody and ETH if you want 100% ETH price exposure on your position. You could do that against USDC if you want higher rewards and higher incentives, higher fees, but you don't want higher 100% ETH price exposure because you'd get 50% on USDC, right? Or other opportunities like that. So LPing is basically that. The risks we've covered. So basically, you're getting impermanent loss, but you're also getting a lot of incentives on top of that. Or you could probably go to a money market, for example, Aave or Euler on Mainnet, and deposit stETH as a collateral asset. And then one of the most common strategies is for people to borrow ETH against that. And then they take the ETH that they borrowed against their stETH collateral, and then they stake that back with Lido or purchase stETH on the secondary market, same thing, and then deposit the new stETH again as collateral on Aave, and then do this recursively 2 or 3 times, and basically get leveraged exposure to stETH and hence leveraged exposure to the yields that you get. So that's a way to just massively increase the yield that's ETH denominated from staking itself. And then last strategy that a lot of people use as well would be, for example, to use stETH, or in this case, wrapstake as collateral on Maker. So you could open a Maker DAO vault and basically mint DAI against that. And basically the prices for minting DAI against wrapstake on Maker are pretty low. They're some of the lowest. So if you want to open a vault on Maker and mint some DAI against that, a very good option is to use wrapstake there. So I'd say these are like the main strategies, right? So you could either hold it just plainly, and that's perfectly fine. Like most or a lot of the TVL just does that, and you get a pretty good yield from Ethereum staking itself, and you're also helping secure the network. Secondly, you can LP that. You can choose the token that you want to LP against, depending on the different risk profiles that you're comfortable with. Or thirdly, you can use it as collateral and then take loans against it. And given that those loans could be ETH to recursively or leverage stake again, or they can be just stablecoins if you want to go farm with them, or if you just want access to some stablecoins without selling your collateral.
Very cool. So I think that's very comprehensive, covering those three strategies you shared. And just back to your point where you said, liquid staking really opens up a whole world of DeFi. I really think so as well. I think from the Kyberswap perspective, I think we see that every time there's a new way to earn or new way to use DeFi and their assets, it kind of really opens up a whole wave of utility users and so all sorts of use cases. So I think really excited to see our collaboration take place even further. So let's talk about the next question here, which is, and I think you touched a little bit about it. Why do Ethereum users trade between ETH and Repstake ETH, and why should we believe it can be better? Could it be better than plain ETH? Your thoughts, please.
Okay. Here you mean trade as in trade back and forth, so trade quickly and frequently between Wrapstake ETH and ETH, or you mean just switching from ETH to Wrapstake ETH? Probably
I
the latter.
be both, yes.
Okay. So assuming the latter, like because that's the most common behavior, right? Rather than the first one.
Right.
Um, I think it's pretty. It's like again, I'm super biased and not giving financial advice, but I think it's like a pretty um, decent choice and a pretty justifiable choice in general, because uh, the main advantages to holding ETH, I would say, first one, you get price exposure to ETH. So you're basically long ETH. If it goes up, you do well. A lot of people in the space believe in Ethereum, believe in ETH, so they would want to do that. You get that same price exposure, pretty much the exact same, if you use wraps like ETH or stETH. So that first one is pretty covered. Then the second one would be to use it in DeFi. So ETH is the best collateral in DeFi in general. ETH and stablecoins, right? But ETH, it has even less trust assumptions, and it's basically integrated everywhere. So whatever protocol in DeFi you want to use, assuming that it's Ethereum or L2 centered, which is what we're mentioning, ETH will be accepted as collateral everywhere, in LP pairs everywhere, etc. So I would say that's kind of like the integrations angle. And over the past 2 years, Lido has integrated wraps like ETH or SETH pretty much everywhere that ETH is as well. So most of the major protocols um, have integrations with both, and they are pretty comparable. Of course, like ETH still has less of a risk premium than wraps like ETH, as it should. But in terms of integrating it everywhere, it's pretty much done. There's one or two major elephants in the room that haven't done it yet. Then basically, without taking too much of a drawback, because you can still use it everywhere, you still have liquidity on it, you still can enter and exit positions as you wish. So without a lot of drawbacks, you get the staking yield on top of having all of that, right? Of having all of the integrations, all of the liquidity, and all of the ETH price exposure. On top of that, by holding stETH or wrapped ETH instead of ETH, you get just the yield on top, almost for free, right? Almost without a drawback. The drawbacks are that, of course, you're interacting with a new smart contract. So just as everything in DeFi, there's risk there, and then just slightly um, less than ETH in terms of like risk parameters or liquidity, etc. But for any sizable amount, like any retail participant or even DAOs and institutions, you could very comfortably hold hundreds of millions of dollars in stETH and still have liquidity for that, still have venues in DeFi to use that, etc. So basically, you don't lose that much in other than just slight assumptions of smart contracts, because of course you're interacting with them, and you get just the yield on top, which is pretty good. So um, like personally, I would use wraps like ETH or SETH instead of ETH. Also because the strategies just function much better if you're using a yield bearing collateral, right? So if you're using, for example, STETH on Aave instead of ETH, and then whatever you're borrowing basically gets a bit offset in terms of interest that you're paying by the interest that you're making on your collateral, while that wouldn't happen with ETH. So even if you're borrowing, for example, stablecoins, of course the yield is denominated in different things, but you're basically buying some yield to borrow those stablecoins, but you're also making some yield from the collateral being STETH there, or on Maker, same thing there. Um, and also, then there are basically the net new strategies that are enabled by this that wouldn't be possible to do with ETH. For example, the leverage staking one that I mentioned on Aave, which are pretty net new to LSDs.
Very cool. So you mentioned this earlier. In some of your strategies, or even taking the position of an LP, there will be some exposure to impermanent loss. So for a user who's trying to prevent this, what would be your plan of advice, especially when it comes to rep stake ETH LPing specifically?
Yeah. So whenever we're LPing volatile pairs, um, there's pretty much no way around some impermanent loss in DeFi. If it's the AMM model, right? So if it's not an order book, which is not in the AMM model, it's pretty much something that's built into the design. Um, Again, like impermanent loss, just to anyone that isn't as familiar with it, it's basically the difference in value after some time period between holding the initial tokens that you were going to LP plainly on your wallet. So, for example, if you want to LP wstETH and USDC on Kyber on mainnet, basically you had the counterfactual option of just holding 50-50 on your wallet, right? So the difference between the returns made by that versus the returns made by the pool, except fees, that's basically what's called impermanent loss in DeFi. The reason for that is that in an AMM design, if one token is going up in value relative to the other, so if wstETH is going up in value relative to USDC, basically the AMM itself is selling the token on the way up. So as the token goes up, it's effectively exiting that position progressively and accumulating the other token that's going down in quotation marks relative to the first one that's going up, and vice versa, the same thing. So if one token is going down, it's basically accumulating that token on the way down by selling the other one. So basically, what that leads to is that you get less. You basically get a loss relative to just holding the two tokens flat, because you don't get all of the upwards momentum when it's going down, and when it's going up. Sorry, not down. Basically, the why do people LP given this, right, is that they're getting fees, right? So all of this is not taking into account fees, but with fees, basically they're getting paid by people using that liquidity that they're providing and trading against that, and paying some fees, leaving some fees on the pool actually for them to collect. And then on our case with Kyber, you still get some LDO incentives on top of that. So other than the fees, you still get other LDO incentives, and actually with Kyber, some KNC incentives on top. So you're getting three main sources of gain there, which is fees, which are denominated in the pool tokens themselves, and then you get LDO and KNC on top. So you can look at it as, at the question two ways. So one of them would be, how do I minimize impermanent loss itself? And then the second one would be accepting some impermanent loss. How can I still make the strategy profitable, even though I'm going to take some impermanent loss? Because there's three sources of profit on top of that, right? So on the first one, basically you have a trade-off in every AMM, which is, for example, for Kyber Elastic, the liquidity is concentrated, right? So you can choose to provide your liquidity for our pool there, just in a range. So you can, for example, choose to just LP ETH and USDC between, for example, $1,000 per ETH and $2,000 per ETH, for example. And basically, the trade-off is that the broader you go with this range, so if you opted, for example, between 0 and 5,000 instead of 1,000 and 2,000. So the broader the range of liquidity you're providing is, the less impermanent loss you're going to take as the price moves there, because it's not moving as much relative to your range, right? Your range is bigger, so a price movement is not as relevant and not as large relative in percentage terms to your range of liquidity provided. As it would if it was super concentrated. For example, current price for ETH is $1,283. So you could LP as concentrated as, for example, $1,100 and then $1,300, just around the current price. The thing there is that with a slight price movement, it could just get out of your liquidity range very fast. The trade-off is that the wider you go, the less proportional fees you're collecting for the liquidity that you're providing, right? Because your liquidity will just be super spread out. So as people are trading, they're just utilizing a small percentage of your liquidity in the middle of that range. And so other people that are much more concentrated, even if they have the same amount of TVL as you in that pool, they're just contributing much more to the active liquidity that's being used in the middle of the range at the current price. So they're getting paid much more in fees than you, even though both of you LP the same amount of TVL. On the other hand, that person will take more impermanent loss if prices move. But if prices don't move and they stay around the current price, they'll just be making many more in fees than you. So basically, that's a trade-off. If you think it's basically what you think is going to happen with the price itself for ETH, or in this case for wstETH. But if you think we're gonna stay in what's called like a crab market, right, as Open calls it, which is uh, staying around the same price levels, you could go more concentrated in that respect than if you thought that we would be shifting and the volatility would be super high up and down, or even just up or just down. So if you think it's going to stay around the same amount, you could concentrate your liquidity much more on Kyber Elastic and don't not risk as much IL because that's your view of the market, and just be paid much more in fees for that. Or you could just go much wider if you're not certain and don't risk as much IL, still get rewards, still get KNC, LDO, and fees themselves. So yeah, that's kind of the trade-off. Like, of course, I don't really have a view of the markets, but for anyone that does,
I
that's
think that's a great explainer, understanding the trade-offs. So I think we understand that if users take their reps, take ETH, they participate in liquidity, they get fees from providing liquidity. And then in the case of the partnership with Kyberswap, right? So we get additional incentives, let's say LDO, KNC tokens, in addition to getting the best rates on Kyberswap as well. So the question I do have here is, what benefits would these farms actually have for Lido?
yeah, absolutely. So for Lido, um, like all of actually those I mentioned three of the things that make liquid staking a better alternative to just native staking, and two of them are purely enabled by liquidity on secondary markets. So the first one isn't really; it's just a like a pool model, right? So the first benefit being that you can stake any amount. You don't have to stake 32 ETH or multiples of that. You can just like, for example, half a ETH or zero point 0.1 ETH or 1 ETH. So that's just because it's basically staked inside of a pool, and then you just have a participation in that pool of ETH staked. But then the other two benefits are driven mostly by the liquidity that STETH has or any other LSD has. So the other two benefits being, one, you can exit those positions as you wish. So for that you need secondary liquidity. So that's one of the reasons why we incentivize these farms or these pools. So basically, we want to have people be able to exit their HTETH position whenever they want, and if they can exit to stablecoins, if in addition to ETH itself, awesome for users, which is why we have the USDC pool there. Then the other advantage being that HTETH is integrated across different protocols, a big portion of that being used as collateral, and the only way in DeFi that you can have any token, any asset usable as collateral is if that token is extremely liquid on chain, preferably. So whenever you're using something as collateral, you need the ability to eventually liquidate that position in the future if that collateral drops in value relative to the borrowed amount against that. And the ability to liquidate is essentially driven by how deep the pools for that asset are. So that's why we have as deep pools as we have on Curve, Balancer, Kyber, and others. And yeah, so that those are basically the two reasons. So we want to have very deep liquidity on chain and across different venues, like we do, to be able to have other partners or other protocols integrate STETH with very good risk parameters because of how deep it is in pools. And then also to give users the ability to go in and out of these positions and have secondary market liquidity for them, and not be stuck to a staked position, and actually feel that like they can exit those positions whenever they want. For retail users, this would be fine with much less TVL. But for example, if you're a treasury manager for a DAO, or if you are a fund, a liquid fund in DeFi, etc., and you want to, or an institution even, and you want to enter a liquid staking position, you're obviously going to go for the one that has higher liquidity because if you're entering a $200 million worth of stake this position, you obviously want liquidity to be much higher than that, uh, which is the case, right? So yeah, that's kind of those are kind of the advantages why we incentivize pools and the benefit that incentivizing pools brings to us. A point here is that on mainnet, the deepest pool for stablecoin pairs against Rapstick is on Kyber. So basically, if you are trading between wstETH and then USDC, being the main stablecoin, yeah, the deepest pool we have is on Kyber. So that's a good thing to know as well and keep in mind.
Super. Thanks for that. I hope you guys are all enjoying the gems that Carvas is sharing. I sure am. Moving on to the last question before we go to the users' questions. Being in the industry, I think we both Lido and Kyberswap have very long term interest to further DeFi, long term games, right? How do you think that this partnership is benefiting the ecosystems, especially with these pools being spread out across not just mainnet, but including the L2s, Polygon, Arbitrum, Optimism, so on?
Yeah, cool. So I think that as someone that's working in DeFi and just very enthusiastic and a lover of the space and also a user of the ecosystem and the product protocols, I think that whenever we can do these types of partnerships, there's a win-win scenario, meaning that um, both of us are better off by doing it than just by trying to get to these goals alone, right? This seems kind of like a cliche, but it's really true in this case, because let's look, for example, at our partnership on mainnet, which is the one that I'm closer with. We also have the L2 and the Polygon side, but on mainnet, for example, we partnered with Kyber uh, maybe like a month ago. We have been in talks previously, but in terms of launching the pools, maybe like close to a month ago. And um, the two sides of this, right? Lido and Kyber. So for Lido, uh, what we have is that we have a very cool AMM design that's concentrated liquidity. We have custom fees there. So the fees on the pools were negotiated and were talked about and modeled to be very low so that people could trade in and out of those positions with very low fees, and also to drive volume to the Kyberswap protocol itself. Because if that's the lowest fee tier that you have for that specific pair, then people just take their trading activity there. But that's also good for Lido because it's just a way for our users to enter and exit those positions more freely with less costs. Then, secondly, we're basically both contributing to things that are benefiting the both of us. So, for example, Lido is giving a significant amount of LDO incentives to the pools on Kyber each month from our reward program. And that basically attracts a lot of TVL to Kyber, right? A lot of people that have ETH, that have wstETH, that have USDC will want to LP that there to get a cut of those rewards. So that brings TVL to Kyber, making those pools liquid and then making people want to use them because they have liquidity and they can be used for trades. And then for Lido, for the rewards that we're giving there, uh, you guys are also bringing your own part of the rewards to the table and to the deal, where Kyber um, LP'd a significant amount of ETH on the wstETH to ETH pool that you guys have there without taking rewards. So you guys made that pool liquid as well and usable for your users, but also for our users, which is again mutually beneficial. And then Kyber also gives KNC rewards on top of LDO rewards, bringing even more TVL to the exchange and even more, even better prices to traders, and hence more volume, more trading activity. So, if we were doing this strategy by ourselves, it would cost pretty much double than it's costing now for each for any of us, right? So, if Kyber wanted to have as the pools for USDC wstETH or wstETH without collaboration from Lido and the LDO incentives on top, you basically have to spend much more in terms of KNC and much more in other ways of incentivizing that to get the same usage on your exchange. And for us, we'd also have to spend more in LDO to get the same amount if you were not helped by Kyber. So basically, like, we're not an exchange, right? We're just a provider of liquid staking. So uh, we want to partner with protocols like yourselves that can bring some value on top of how much we're incentivizing users of your exchange, right? So I think it's a perfect example of a partnership in DeFi going well. In terms of it being mutually beneficial, it totally is, and yeah, it brings users, TVL, fees, etc. for Kyber, and for us, it's another source of liquidity that people that want to enter or exit wstETH positions can go to.
I love the virtuous cycle and a synergy that it really drives for everyone, including the whole network. So we're done with all the main questions. Let's move on to the second part of the AMA. The second part of the AMA, guys, is the questions that we received on Twitter. Right, so we have selected 5 questions, and the 5 users that have been selected, you guys have won 5 individual rewards, and the team will be in touch with you. So let's run through them right now. The first question is from Devi Sri 786. What is the structure of Lido Finance? Is it decentralized or an open source protocol where everybody can contribute? If so, how does the governance plan on being handled?
Mm-hmm.
Carlos?
So Lido is kind of two things, right? So Lido is a DAO and Lido is also a protocol, right? So if you're mentioning like the organization or the governance structure, it is a DAO. So like a decentralized autonomous organization with the governance process that I will go into. And then you can also mention Lido just as the protocol itself. So the set of smart contracts that people interact with to use the products, right? STETH, STmatic, STDOT, STKSM, and STSOL, which are our current products. In terms of the DAO, so the organizational structure that governs the protocol, essentially the Lido DAO functions as an Aragon DAO, so pretty standard. Our governance process has, I would say, 3 main phases. So the first phase is just completely off-chain and completely vote-free discussion. So if any of you are interested in the current proposals that are going on at Lido or being involved in governance in general or ideas, you could go to just research.lido.fi. That's our research website or a governance forum, as it's called as well. And there, it's just basically permissionless discussion on whatever's going on, whatever's being decided, and new ideas and also existing ones. You can give us feedback on everything, and you can also propose your own ideas. Um, for example, my area of work, so liquidity, rewards, incentives, etc., all of that is published um, very det- in a very detailed manner there every month for what incentives we're going to give out in the following month. So we publish, for example, we try to be as transparent as we can. So on that site specifically, which is the one that I can talk about myself, we publish like all of the different allocations of incentives that we propose to the DAO to give to each DEX, each pool, each integration, etc., and do this for all of the chains that we're on. Basically, there it's just normal scenario for a governance forum where people can just discuss, share ideas, give feedback, try to be constructive, hopefully. Then those proposals pass to Snapshot normally. Snapshot is just a very standard tool as well, so people can just do votes there, either for either like as a temperature check, like checking if in general people would be pro or con some proposal, or for less significant things. But yeah, also like you can check the snapshot.org, you can search for the Lido DAO there, and if you have LDO, you can vote there too, for mostly temperature checks and sentiment checks there. Um, and also a couple other votes as well. And then the last phase is just full on-chain DAO governance, and that's also outlined in our website. If you go to our website, right at the bottom, there's the DAO link where you can just literally vote on-chain for proposals that are going to be implemented. And yeah, if you have LDO, you can participate in all of those processes. If you don't have LDO, you can participate still in the first one as a community member. So the first part, the research forum, the governance forum, it's completely open to anyone to give ideas, ask stuff, commentate, and we do want to incentivize community participation there. So if you guys are interested, there are a bunch of interesting proposals there that we want people to look at and we want to receive feedback on. If you're interested in doing that, I can give a couple suggestions. So a very cool one that's not even related to what we've been talking about here is our current dual governance proposal. I'm not going to go into it, but it's basically how can we have a dual governance system with LDO voting and STETH holders eventually vetoing votes in extreme scenarios? So that's a very interesting one for you to look at. You can also look at the ones related to liquidity and rewards that are normally done by myself or the other people in the rewards committee at Lido. So yeah, so basically that's the process. It's pretty standard compared to a lot of DAOs. So we have the discussion completely free to participate in on the governance forum. Then we have snapshots, and then we have full DAO on chain voting. Um, Let me see if I missed anything here answering. So everybody can contribute. That was one of the questions. Everybody can contribute. That's true. So you could like find different ways of contributing. You could go to our Discord, ask us questions or answer questions from other users that you know about there. Also on our governance forum, interact there. I think those would be interesting ones in the beginning. There are obviously many other ways to contribute, like just autonomously doing marketing work, like threads, etc. Um, and yeah, and how does the governance plan to be handled? I think I've pretty much covered that. There's basically that three-phase process for the DAO.
That's a super in-depth inner workings spotlight, right? I think for those who are really interested in being part of the Lido governance and community, I think there's lots for you guys to do, just as Carvas shared. So I hope that answers the question, Davy Sri. Next question is from Kimchi Swap. I see that Kyberswap is integrated into 13 chains and Lido has enough locked assets to solve the liquidity problem. What I'm wondering is, can the liquidity problems that may, let's see, occur in a wide range of blockchains be solved with the cooperation of Lido and Kyberswap? You got the question, Carvas?
Yeah, I think so.
Okay, cool.
So Lido is very far from being on 13 chains like Kyber, so congrats on that, guys. Uh, right now the chains that we support are Ethereum, Mainnet, Solana, Polkadot, and Kusama, but we do the EVM compatible ways of supporting them, which is basically Moonbeam for Polkadot and Moonriver for Kusama, and then Polygon, so Polygon POS chain, and then the L2s, Arbitrum and Optimism, which are essentially the L2s for Ethereum. So those are the ones we're deployed in. Or in the case of L2s, that we are bridgeable there too as well. So in terms of solving liquidity problems, I'm not 100% sure what's the direction of the question, but the way I understand it, I think like on the chains that we're on, especially mainnet and L2s, we do contribute a lot to the liquidity on those chains because, for example, STETH is one of the tokens in general, or one of the assets that has the deepest pools in DeFi. Like I mentioned, right? We have like north of 1 billion of TVL overall in the pools in this current bear market. Like when it was during the peak of the bull market, we have multiple more billions than that. Of course, ETH price was also higher. But yeah, I think it does really contribute to the liquidity on those chains. Um, it also contributes to other composable Legos. For example, even on like lending protocols. For example, if you are a lending protocol like Euler or Aave and you list STETH as a collateral asset there, that's going to benefit a lot the other pools, not pools, but the other assets that you have there, and the liquidity on those as well, because like there's very little demand on money markets to borrow with, for example, if not to do this leverage staking strategy that I mentioned with STETH. So if you don't have STETH listed there or another LSD, basically the rights for people supplying ETH are going to be much lower because they're also being utilized much less, right? And so it has kind of like trickling effects where by having STETH there, then there's more demand to borrow with, then people that are supplying ETH also get paid more interest. So there's more TVL of ETH too, which basically increases liquidity for that market, for other participants that don't even care about interacting with stETH, and then on pools as well. So, for example, our pools on Kyber also contribute to liquidity outside of Kyber, just for the space itself, for the chain itself, because it's routed via aggregators that end up routing some of the trades via the Kyber pools, or at least parts of them, uh, and ends up even being a routing pair for other trades that don't even involve wraps like these. So that can end up being in the middle of those routes there. So I do think it contributes to liquidity. If we can single-handedly solve liquidity problems on all of the chains, I'm not sure. I think that it's important to have a strong organic DeFi ecosystem on chains to have liquid staking tokens or products be usable and useful there. Because the way it works on Ethereum, which is the best case right now, is that there's all of this utility, all of these use cases, and each one of them complements the others. And that's very important for us to see whenever we are thinking about deploying to a new chain or entering a new ecosystem. That's why we entered this year, late 2022, the L2s, Arbitrum and Optimism, because the DeFi ecosystems there looks promising, had organic adoption and usage, and so we ended up going to those two. So yeah, I'm not sure I answered 100% of that, but I think I was almost there, maybe.
Very cool. I think the next question, probably less technical, but I think very important, from Shishir Singh. Do you think the real value of DeFi has been understood by people after FTX crisis? Will it take to DeFi to a new height in the upcoming bull market? What do you think?
Mhm. Again, I'm gonna be super biased in this one because I'm someone that's very, very enthusiastic about DeFi and finds it very usable, useful and also interesting in general. So I'm gonna make the DeFi bull case or the DeFi pro case, just personally. I think that uh, I have a lot. I have this conversation a lot with people that are in finance or other friends of mine that are in more traditional industries that basically get fed the mainstream news or narratives about crypto in general, right? And not and don't really distinguish between what a decentralized protocol is or what a company running a centralized exchange is. I think that's a problem of our industry in terms of just communicating the differences there, and that's up to all of us to do. But my view is that collapses such as FTX's, I was actually a user of FTX. I thought that the product itself was very good. Like it was probably the best sex around for perps in terms of cross margining and all of that. So the product itself was very good. Of course, like the risk management went out of the window and it ended up collapsing because of very bad practices on the back end. But the product itself worked, and I'm mentioning that because I think there's stuff to learn from those products that do hit product market fit like it's had. FTX did have product market fit for perps and for trading in general. And I think we can take stuff away from that to build DeFi protocols that, like in DeFi, we normally say it's not don't be evil, it should be can't be evil, right? You should have your hands tied in terms of doing whatever happened at FTX, right? That's something that would never happen in a transparent open state protocol in DeFi because people could just check the chain and see where their funds were going. And
Exactly.
and yeah. So I have like maybe 2 or 3 points here. Sorry for taking a bit on this answer, but the first point is that that would never happen in DeFi. There are other problems in DeFi, for example, smart contract risk, like we have been mentioning, and exploits, which are something that the industry needs to work on. But problems such as what happened there specifically would never happen in a transparent protocol. And the second thing is that, uh, like even for example, when Celsius collapsed and other CeFi lenders, which is kind of like a similar thing to this, um, the protocols in DeFi, like Aave Maker, still got their loans paid. So even if FTX, Alameda, and the other lenders defaulted on, or even 3AC defaulted on any sorts of loans, they still had to pay loans on Maker and Aave and Compound, etc., if they had them there. And there's literally no way around that, right? It's just a smart contract with rules, and they do have to do it. So DeFi worked well throughout all of this. Like this year was a super tough year for crypto in general, but DeFi, not in terms of the token prices, but just in terms of the protocols and the products, it worked perfectly um, with all of these crises, with extreme amounts of volatility and all of that. So that's a reason to be proud of the industry, I think. And then just the third point is that we essentially um, need to build solutions that are as good as those products, but don't have the liability or the counterparty risk, as it's called, of being run by a company and being with a closed backend, basically a proprietary database instead of a blockchain, right? So, for example, a lot of people ended up, not as many as we would hope, but some people that were trading on FTX ended up moving to DYDX, for example, or to GMX on Arbitrum to do the same types of perps trades, but to do it in a decentralized way. I think the key thing is basically that it's self-custodial, where there's literally no way for them to take your funds because you're holding them yourselves. So modulo a smart contract attack or an exploit, you're pretty much better off than in a CeFi exchange. So basically, I think that it is bullish for DeFi to have all of these centralized players collapsing this year. The problem I think is that outside of these circles, in mainstream circles, everyone thinks that it's bearish for DeFi because they bucket DeFi inside of crypto in general, and there's not really a differentiation between what's a protocol, what's a set of smart contracts, and then what's a company running a database and an exchange.
Yeah, I think completely agree with you on that. I think we are in a DeFi maxi room right now. And for those of you listening, if you guys haven't converted, I think now is the time. So let's move on to the next question. So the question comes from Anlan quadruple nines. Why are there some farms with APR so high but still losing? Can you share some ways to optimize the LPs?
Mhm. I'm not sure in this question what's meant by still losing, because basically, like we mentioned when we were talking about the concentrated liquidity section, uh, like in AMMs, there are risk on positions, absolutely. So there's going to be some positions that are going to end up with a positive PNL, and then others that are going to end up red or negative. Um, Basically, I think it's back to what we mentioned in the beginning. So you have to basically look at what's adding to your PNL or subtracting from your PNL, and just basically try to make choices that end up being EV positive, right? That you expect to end up positive over time. Of course, it's never guaranteed because it's a risk on position. But for example, my view, if I was LPing on Kyber Elastic for wstETH and USDC, would be uh, first of all, main thing is, where do you think the price of ETH is going? So, like we mentioned, if you think it's going to be pretty much around the current value, you can go much more concentrated. And if you go much more concentrated, you can kind of estimate how many fees you're going to get based on current volumes. So you just look at current volumes per day, you average that out over maybe like the past 2 weeks or so, and maybe even weigh a little bit more on the previous days, and then just try to multiply that by the fee tier and see how many fees you're supposed to make if you LP some amount of capital there. And then you had to add to that the APR that's displayed. So you add like the LDO incentives, the KNC incentives, and what portion of those you would be expected to make. And then you get to an amount, like an amount of total compensation that you would get there for LPing over a given time frame. And then you just try to look at how much impermanent loss you would be expected to make as well. This is the trickiest part. Like the first part is the easier one. The second one, like the negative side, is the trickiest one, because of course you need to have a directional view on ETH to make that profitable. So it, like, depending on your directional view, if you think it's going to stay around the same prices, if you think it's going to go up a lot, down a lot, etc., you'll just end up switching your ranges around there. I think that, like, concentrated liquidity ended up shipping April or May of 2021 in general in DeFi. And I think it's like one of the most complex products that we have, either like Kyber Elastic or the other concentrated liquidity venues. And that even a year and a half later, or more than that, even, there's still a lot of people that are not sophisticated helping there, and there's a big like, of course, it's like a net new product in DeFi, right? There's no comparison in TradFi or in other markets for the specific design of concentrated liquidity, where it's basically like a mix between the pool model and the advantages of that, of being permissionless, of being open to retail, etc., and also of being there at any time, instead of, for example, in a club, in a central limit order book, where you have to go to the exchange when there are counterparties trading there, because you need to trade against people or against institutions. On the AMM design, on the pool design, you basically trade against the pool, so it's always there, the liquidity. It's not synchronous with other people trading there. So it still kept that, but also got some of the benefits of a central limit order book, or an order book design, where people have much more sophistication in how they want to provide that liquidity, and there are many the market making strategies are much more complex, or potentially much more complex. I think that, like, the concentrated liquidity venues have been gaining a lot of share, which is very good to see and is expected, because it literally is more efficient. Because even if you wanted to do the full range liquidity, for example, on the normal uh, x times y equals k normal design, you can still do that design in a concentrated liquidity venue by LPing in the full range. So you don't lose anything. You just have many more options to use any range that you want. Another cool thing that may be interesting for the person that's asked this question is that we're also working on some materials with Kyber for different ways of using concentrated liquidity. So, depending on your views, depending on your risk appetite, on the bets that you want to make, um, we're going to put out some materials like videos, animations, and threads, etc., about different strategies that you can use. So you can also look at that, because again, it's a much more flexible design that has a little bit more risks, but also enables a lot more risk profiles and risk exposures there. So just like pulling it, sorry, I kind of like ramble a bit, but pulling it back to the question, um, I'm not sure I agree with the part like but still losing, because it's just like a general risk on position. Like, you could also ask, why are ETH holders still losing? Like, some of them are, some of them aren't, right? Depends on when they entered, the types of strategy that they did. So I would say it's much more individual focused than just in general, because we're not uh, really talking about like full range liquidity, where for that we could say like this pool is losing or gaining after some time frame. But for concentrated liquidity, it just depends on how people are managing it.
Very cool. So let's end off this second segment with the last question, and he comes from the last question is from BIVNSN saying, I really, really like Kyber network farming pool. By the way, when I want to farm in the pool in Ethereum, I need to do 6 transactions. And I think it's too much and it gets a lot of transaction fees. What should I do to decrease the gas fee or for Kyber to decrease the steps? So I think this is primarily for me. So I'll answer quickly first. One is, I think, yes, we recognize that there's a number of steps that's being made on our side for Kyberswap. We are actually in process to improve the UX and minimize the number of transactions. So we recognize that it's already being worked on. I think the second thing I would mention is like what Caravas has mentioned earlier. What we have is essentially a new type of concentrated liquidity product, which is really not seen before in DeFi or even in TradeFi as a comparable. So I think this is something that's pretty early. I think Kyberswap is probably one of the pioneers in the space, really building this out as well with our auto reinvestment curve, with our farming as well. So I think, yeah, so I think there's obviously certain pros and cons to it. As I think we all know about the current partnership and between Lido and Kyberswap, and the benefits that you can earn as well by participating. On our side, we're doing our best to ship those improvements as fast as we can. So thanks again for that question. Carver, is there anything you'd like to add on?
No, I think that was a question for you. So yeah,
Sure.
well answered.
So let's move on to the last part. Uh, Live questions. 5 questions from viewers live. For this part three of the AMA, we will choose 5 questions here. We are specifically looking at the YouTube's chat box. To be eligible for the reward, please ask questions in the following format: your question plus your Telegram username. Please make sure you fill in your exact username. So let's give everyone one last round of maybe about 10 to 20 seconds. Type in your last questions and we will begin in just a bit. Really appreciate the complete and thorough answers you're giving so far, Carvers. I think this 1 hour and 15 minutes is probably way too short. I'm sure you could go on for hours on this.
Yeah,
so let's
absolutely.
yeah, so let's go to the first question, team. Let's look at the first question. Okay, so from Coffee Cup, Coffee Cup asks, how do I measure opportunity costs between different LPs? Harvest?
I think it depends on what kind of opportunity cost we're talking about here. I think I think like there's two ways of looking at it. So uh, one, like in terms of opportunity cost, two ways. One of them would be the opportunity cost of LPing there. Like if you have already chosen a pair, if you already know that you want LP wraps like these to USDC, for example, on Kyber, you have the opportunity costs of LPing that versus just holding those two assets on your wallets idly. So that's kind of an opportunity cost because you have a different um, exposure in the LP than just holding them in your wallet. And that's the impermanent loss part that we talked about. So for that, I think we pretty much covered like all of the trade-offs and all of the thinking that you have to go through. But that is a kind of opportunity cost. Then the second one, which I think should be much closer to what Coffee Cup wants to know, is like between the different LPs. So I think like between the different LPs, we covered slightly for two examples. So between, for example, LPing wraps like these to ETH or wraps like these to USDC. So between those, for example, just to cover it again, the opportunity cost is that if you are LPing half USDC and half wraps like these, you lose half of your exposure. It's like approximately half of your exposure to ETH price going up if in the future because you already have like the other half. But of course, you also lose half of the exposure if it goes down. So if it goes down, you also are better off holding half than just wraps like ETH and ETH, which is a pure ETH exposure position. So that's one. The second one is fees. So the more traded against your pair is, the more fees you're gonna make. So if you are LPing in a pair that's not really traded against, or that's very idle, like a liquidity pool that's not utilized as much, then you have the opportunity costs between LPs, I guess you could say, of losing fees that you would be making on the other one, on the one that's more traded against. And then thirdly, this is even more important in bull markets, I guess, than now, but still now it's important, the incentives that you get on each pair. I think that one of the main reasons for people to LP is to get the incentives from liquidity mining that are given on top, and different pairs will get different amounts. And also, different people will expect different amounts of incentives on top of a pool to have comfort in LPing in that pool. Because, for example, people that LP USDC to wraps like this require like the market prices that a bit higher in terms of requiring more percentage returns in incentives on top than, for example, ETH and USDC. Because of the impermanent loss and all that. So I think it's pretty much what we have been talking about. So fees, incentives and rewards on top, and then just the plain exposure that you want to have, which are the tokens that you are LPing themselves.
Very cool. So let's move on to the next question from Wok Kong Tran. What is the future development direction of Lido after Ethereum staking withdrawal is open?
Mhm. Very relevant question, one of the most important questions for Lido at the moment, and it's one of the biggest priorities internally inside of the DAO. I'm not involved in that side of work, so I'm not going to be able to give a lot of context there. But you have very good posts about it and already some very good discussion happening on our research forum. So if you want to go deep on that, you can start engaging there and also just reading what the discussion has been so far. In terms of future development, of course, Lido is going to work towards implementing withdrawals for staking, just like all of the other protocols that do this. In terms of very specifics or concrete details, I couldn't give them to you because I'm more on the DeFi side in terms of like strategies, liquidity, BD integrations, etc., and not so much on the upgrade side. So I would advise you to go to the research forum and just read up on that.
Sure. Let's move on. Next one is from Peter Zeit. If users farm wstETH on Kyber, how many exact profit tiers levels will they receive?
I'm not sure. Is profiteers and levels a term that you use at Kyber, or I'm not sure what.
No, not specifically.
Okay, like then the way I understand the question, you basically have three maybe. So you have the trading fees themselves that people generate, and that's extremely organic. It's just people trading against it. Also, a cool thing to note is that there's currently a trading competition for wstETH and USCC on Kyber that you guys enabled a few days ago. So if anyone is interested in looking at that, feel free to do it as well. With and there's rewards and prizes and all of that. So first of all, it's the trading fees. That's one of the tiers. Then the other is LDO incentives on top, and then KNC incentives on top. So Kyber's governance token, Lido's governance token are also given to LPs that participate in providing liquidity to the pool, in addition to the fees. So I'd say those are the main ones. And also, of course, you get price appreciation. If the assets that you are helping, in this case, wstETH, increases in value, you, of course, get price appreciation that way as well.
Very cool. Thanks. Next question is from AppTech Earning. What has the effect? What has been the effect on liquid staking from a current market situation? Did more investors start liquid staking than normal staking their crypto?
Okay. Um, the basically like the effect, I would frame it as adding a lot of capital efficiency to the act of staking, which was one of the biggest problems of staking, specifically in Ethereum. I would say maybe a little less on the other networks, but still on the other networks as well. But yeah, I would say that the main effect has been allowing people to participate in securing the network when it's proof of stake, which is like one of the motivations to stake, in addition to the yield or the rewards, and then make that capital efficient at the same time. So what we have been talking about of being able to use those positions in different protocols in DeFi, or being able to leverage up on those, or borrow against those, or exit those positions eventually, or LP them. So I think that has been one of the biggest things. The other is that it has just opened up a way for people to stake at any amount of value that they own, right? So they don't need to be wells, they don't need to have a big amount of ETH, they can literally stake any amount of ETH. You could do that in exchanges prior to liquid staking, or not actually prior even, but just in parallel to the liquid staking options. You could do that in exchanges, but that's fully custodial and fully centralized, and loses a lot of the capital efficiency of being able to use the token representation, which is one of the main things. In terms of did more investors start liquid staking, I'm not actually sure of what the numbers are. If more people are starting to use it as in the liquid form or not, but I think that over time, I think that many more people will be using a liquid staking solution instead of any other sort of solution, be that centralized exchange staking, or um, either even directly staking, just because it's much more capital efficiency and the incentives are all there to do it in the liquid form.
Very cool. Thanks for that. Let's move on. Next one is from XTND. Some projects offer a very high APY on liquidity stakes. How does Kyberswap and Lido finance technology compare? Why do investors choose it over other competitors as investment opportunities?
Okay, so specifically for liquid staking of ETH, again, I'm going to be super biased here. I'm a contributor for Lido and a very big fan of the product itself. So I'm gonna, of course, give the pro case there, but I do think it's the real case. So the reason to choose STETH or to choose like the Rapstack ETH or the way that Lido, the product from Lido for liquid staking, is that it is the number one most liquid staking token or product in DeFi by far. So it has much more depth in DeFi, on-chain liquidity, etc., than any other competitor by a long amount. Like it's not a bit more liquid; it's much more liquid. So, for example, if you are an institution, if you are a treasury manager, if you are a DAO that wants to, or a whale that wants to deploy a large amount of funds, it liquidity becomes much more important, and having liquidity in the hundreds of millions of dollars also becomes very important. So that's one. The second one, it's that it has been around since the launch of the Beacon chain in December 2020. So there's a good history, a good track record of the smart contracts being live, of the product being implemented, integrated, etc. So the battle testedness of it, I think it's also an important factor. And then thirdly, the one that I work on the most, and I think it's also very important, is just how many use cases for it you can have compared to other tokens like that. So if you want to do the more, let's call them advanced, they're not even that advanced, but slightly more advanced strategies, you have many more opportunities and much better ones for SETH than any other LSD token, liquid staking derivative token. So, for example, the ones on Aave we mentioned, the ones on Maker with very good caps and interests as well. Uh, on Euler, for example, it's also the most liquid market there. And then all of the dexes like Balancer, Curve, staking those positions on Convex, taking the BPT positions on Aura, LPing on Kyber, and getting KNC on top. So it's just the most widely integrated LSD. So you have much more optionality and also better options, allowing you to even increase the yield much more than just the native yield from staking itself. So I'd say those are the main ones. All of this comes from liquidity mostly. So the fact that it's just much more liquid in DeFi, it's one of the main advantages that just reduces any problems that you'd have in using that. Yeah.
Very cool. So we've actually come to the end of all the questions for today. So for those of you that had your questions selected, congratulations. The team will be in touch, or you can get in touch with us directly as well with your username. Please do note there is another $500 in awards going to be distributed after the AMA today. And how you can receive that is by heading over to the Kyberswap or Kyber Network Discord. I think the team will also include the link as a comment here, maybe. And you can also look in our description below where you can access our Learn and Earn Discord server. We're excited to be providing you most up-to-date educational materials, activities for you to learn more about DeFi. So a lot of questions from users around learning, trying to figure out DeFi, trying to get onboarded, all the barriers to entry. And for us, we're all about enabling DeFi long term for you, and we want to help you learn more about what DeFi is, how it works, and we've got all sorts of fun stuff planned. So make sure you catch up with the server regularly. Keep in mind any points that you earn in the Learn and Earn Discord as well. but you can accumulate them and take part in our educational programs, and it will be contributed to the next prize that's upcoming. So at this point, let me just thank Carvas again. Carvas, thank you again. Is there anything that you'd like to leave as a parting word to our audience today?
No, just want to say thanks for the invite. I think our relationship is going quite well. I'm very happy working with you guys. Like the Kyber team is very cool, very strong. So if anyone else wants to work with them, I would recommend as someone that has been doing that for a month and a half, maybe. Also, if you want to get more involved in Lido, other than just staking via Lido, I think, of course, staking via Lido, I think it's a very justifiable option and a very cool one. But if you want to get more involved, feel free to come to our Discord. There's always people answering questions. Also, feel free to come to our research forum or governance forum. And yeah, feel free to reach out to us if you have any ideas, any suggestions, or any problems. We'll always super happy to engage community members.
Awesome. Thanks again for being such an amazing speaker today, Carvas. For the users and our friends and community here today, thanks for being such a supportive and giving audience with so many comments and questions. Just a reminder, go and check out on kyberswap.com, go to the Ethereum mainnet. You can check out the exact pools that we've been talking about today, the Repstake ETH USDC pool, for example, on Ethereum chain. If you're really excited about Ethereum, about ETH, about Lido, about Kyberswap, this partnership, you want to find out more ways to earn multiple streams of income in DeFi, you should definitely check that out right now and put your ETH to good or maybe better use as well. So I think that's all from us today. Thank you so much. We'll see you in the next AMA. Cheers.